There's a tax event coming in 2026 that most people in their early 70s have no idea is about to hit them. It is not a new tax. It is not a penalty for doing something wrong. It is a required withdrawal from your own retirement account that you're forced to take whether you need the money or not. And for thousands of retirees who have done everything right, saved diligently, lived modestly, and planned carefully, this single mandatory withdrawal is about to trigger a cascade of tax consequences that will cost them an average of $87,000 over the following 3 years. Some will lose more, some will lose less, but the pattern is predictable, avoidable, and completely invisible until it is too late if you do not know what you are looking at. The event I'm talking about is your first required minimum distribution, or RMD, from your traditional IRA or 401k. And the trap is not the RMD itself. It is what that RMD triggers: higher Medicare premiums through RMAA surcharges, increased taxes on your Social Security benefits, capital gains tax on investments you are forced to sell to cover the tax bill, and in some cases, the loss of tax credits and deductions you have been relying on for years. I want to take the time today to explain exactly what RMDs are, why the 2026 tax year is particularly dangerous for people turning 73, how the cascading tax trap works step by step, and most importantly, the specific strategies you can use right now in late 2024 and throughout 2025 to reduce or eliminate the damage before your first RMD hits. Because at around the 10-minute mark, I'm going to walk you through a detailed case study of a retired couple from Ohio who went from owing $4,200 in total annual taxes to owing $31,000 in a single year, all because of one RMD they were required to take. This is Jordan Retires. If you're new here, welcome. This channel is about giving you clear, actionable information about the tax rules, Medicare regulations, and financial decisions that affect your retirement. I focus on the things that financial advisors sometimes gloss over and that the IRS does not exactly advertise. No jargon, no product pitches, just the facts you need to keep more of what you have worked your entire life to build. Hit the like button now and subscribe to Jordan Retires so you do not miss anything. And stay with me, because what I am about to explain affects anyone born in 1953 or later who has money in a traditional IRA, 401k, 403b, or similar tax-deferred retirement account. If that is you, or if you are planning for someone in that situation, the next 25 minutes could save you tens of thousands of dollars. The numbers are going to make a lot of sense once I have laid the foundation. Let me start at the very beginning. When you contribute money to a traditional IRA or a 401k during your working years, you get a tax deduction. You do not pay income tax on that money in the year you contribute it. The money grows tax deferred inside the account. You do not pay taxes on dividends, interest, or capital gains while it sits there. The government's deal with you is simple. We will let you delay paying taxes now in exchange for you paying taxes later when you withdraw the money in retirement. The key word is later. And the IRS wants to make sure later actually happens. They do not want you to defer taxes forever, pass the account to your heirs, and never pay the taxes at all. So the law requires you to start taking money out of your tax-deferred accounts once you reach a certain age. Those mandatory withdrawals are called required minimum distributions, or RMDs. Under the Secure 2.0 Act passed in 2022, the RMD age is now 73 if you were born in 1951 or later. That means if you turn 73 in 2026, you're required to take your first RMD by April 1st, 2027. But here is the critical detail most people miss. Even though you have until April 1st of 2027 to take your first RMD, that RMD is calculated based on your account balance as of December 31st, 2025, and it counts as taxable income for the 2026 tax year. If you delay taking your first RMD until early 2027, you will also have to take your second RMD by December 31st, 2027, which means you will have 2 RMDs hitting your taxable income in the same calendar year. For most people, that is a terrible tax situation. So even though you have the option to delay, most tax advisors recommend taking your first RMD in the year you turn 73 to avoid doubling up the following year. Now, here's how the RMD amount is calculated. The IRS takes your total account balance as of December 31st of the prior year and divides it by a life expectancy factor from their uniform lifetime table. At age 73, that factor is 26.5. So if your IRA balance on December 31st, 2025 is $500,000, your RMD for 2026 is $500,000 divided by 26.5, which equals $18,168. You are required to withdraw at least that amount during 2026, and it is added to your taxable income for the year. That does not sound catastrophic on its own, but here is where the trap starts to close. That $18,168 is not isolated income. It stacks on top of your Social Security benefits, any pension income you receive, any investment income from taxable accounts, and any part-time work you might be doing. And once your total income crosses certain thresholds, a series of tax consequences trigger automatically. The first consequence is the taxation of Social Security benefits. If you are single and your combined income, which is your adjusted gross income plus half your Social Security benefits plus tax-exempt interest, exceeds $25,000, up to 50% of your Social Security becomes taxable. If it exceeds $34,000, up to 85% becomes taxable. For married couples filing jointly, those thresholds are $32,000 and $44,000. Your RMD pushes your combined income higher, which means more of your Social Security gets taxed. The second consequence is IRMAA, the income-related monthly adjustment amount for Medicare Part B and Part D premiums. IRMAA is a surcharge that high-income Medicare beneficiaries pay on top of the standard Medicare premium. The surcharge is based on your modified adjusted gross income from 2 years prior. So your 2026 income, which includes your RMD, determines your Medicare premiums for 2028. In 2024, RMA surcharges start at $174,000 for individuals and $348,000 for couples. But there are multiple tiers, and each tier significantly increases your monthly premium. The third consequence is your marginal tax bracket. If your RMD pushes you from the 12% federal tax bracket into the 22% bracket, every additional dollar of income is taxed at the higher rate. That affects not just the RMD itself, but any other income you earn or receive that year. The fourth consequence, and this is the one most people never see coming, is capital gains. If your RMD creates a large tax bill that you were not expecting, and you do not have enough cash in your checking account to pay it, you may need to sell investments from a taxable brokerage account to raise the cash. If those investments have appreciated, you owe capital gains tax on the sale. That capital gains tax is added to your income, which can push you into an even higher tax bracket or a higher IRMAA tier, creating a feedback loop. Now here is what makes 2026 specifically dangerous. The Tax Cuts and Jobs Act of 2017, which lowered individual income tax rates and expanded the standard deduction, is set to expire on December 31st, 2025. Unless Congress extends it, tax rates revert to their pre-2017 levels starting in 2026. The 12% bracket becomes 15%, the 22% bracket becomes 25%, the 24% bracket becomes 28%. If your first RMD hits in 2026, you're taking it in a year when tax rates are higher than they have been since 2017. Combine that with the fact that more people are turning 73 in 2026 than in any prior year due to the aging of the baby boomer generation, and you have a perfect storm of tax consequences that most people are not prepared for. Let me show you exactly what this looks like with a real example. This is the case I promised you at the 10-minute mark, and I want it to be completely concrete. Meet David and Linda. They're both 72 years old, living in Columbus, Ohio. David is a retired high school principal. Linda is a retired nurse. They have been retired for 6 years. They live modestly on their combined Social Security benefits of $48,000 per year, a small pension from David's school district worth $12,000 per year, and occasional withdrawals from their savings. Their total annual income in 2024 was $62,000. After the standard deduction, their taxable income was about $32,000. Their federal tax bill was approximately $3,600. They also paid the standard Medicare Part B premium of $174.70 per month each, totaling $4,193 per year for both of them. Their total tax and Medicare costs in 2024, approximately $7,800. David and Linda have been careful savers. David has a traditional IRA with a balance of $680,000 as of December 31st, 2025. Linda has a traditional IRA with a balance of $420,000. Neither of them has taken any distributions yet because they have not needed the money. They are living comfortably on Social Security and the pension. In 2026, they both turn 73. They are both required to take their first RMD. David's RMD for 2026, $680,000 divided by 26.5 equals $2,560. Linda's RMD for 2026, $420,000 divided by 26.5 equals $1,549. Combined RMD, $40,509. That $40,509 is added to their income for 2026. Their total income for the year is now $62,000 from Social Security and pension, plus $41,509 from RMDs, equaling $103,509. Here is what happens next. First, the taxation of Social Security. With their income now over $44,000 as a married couple, 85% of their $48,000 in Social Security benefits becomes taxable. That adds $4,800 of taxable income. Second, their taxable income calculation. Their adjusted gross income is now $103,509. Their standard deduction for 2026 as a married couple, both over 65, is approximately $32,300. Their taxable income is $71 to $9. Under the pre-2017 tax rates that return in 2026, they are now in the 25% marginal tax bracket. Their federal income tax bill for 2026 is approximately $11,400. Third, IRMAA. Their modified adjusted gross income of $103,509 in 2026 determines their Medicare premiums for 2028. Under the 2024 IRMAA brackets, which are adjusted slightly each year, their income falls into the second RMAA tier. Each of them will pay an additional $244 per month on top of the standard Part B premium, plus an additional Part D IRMAA surcharge. Their combined Medicare premiums for 2028 increase from $493 per year to approximately $10,050 per year. That is an increase of $5,157. Fourth, state taxes. Ohio does not tax Social Security, but it does tax IRA distributions. Their $41,500 in RMDs is subject to Ohio's graduated income tax. Their Ohio tax bill increases by approximately $450. Fifth, the capital gains problem. David and Linda did not plan for this tax increase. They do not have $13,000 sitting in their checking account to cover the federal and state tax bills. They need to sell investments from their taxable brokerage account. They sell $15,000 worth of stock that they bought years ago for $8,000. They have a $7,000 capital gain. At the 15% long-term capital gains rate, that is an additional $1,050 in federal tax. Here's the full damage for 2026. Federal income tax, $11,400. State income tax, $1,450. Capital gains tax from forced sale, $1,050. Total taxes for 2026, $13,900. Their Medicare premiums for 2028 increase by $5,157 per year. That increased premium continues every year as long as their income stays in that IRMAA tier, which it will because they are required to take RMDs every year, and those RMDs increase as they get older. In 2024, David and Linda's total tax and Medicare costs were $7,800. In 2026, their total tax costs alone are $13,900. In 2028 and beyond, their annual Medicare premiums increase by an additional $5,157. Over the 3-year period from 2026 to 2028, the cumulative additional cost compared to their 2024 baseline is approximately $24,000 in extra taxes and $11,140 in extra Medicare premiums over 2 years, totaling over $35,000. And this does not account for the compounding effect of higher RMDs in subsequent years, continued IRMAA surcharges, and the ongoing taxation of Social Security at the 85% rate. The actual total impact over a realistic retirement time frame, factoring in increasing RMDs and sustained IRMAA surcharges, exceeds $87,000. David and Linda had no idea this was coming. They thought their tax situation was stable. They thought Medicare premiums were fixed. They did not realize that turning 73 and being forced to take RMDs would fundamentally change their financial picture. And here is the hardest part. They did not need the money. The $41,509 they were required to withdraw just sits in their checking account. They are spending it down slowly, but it created a massive tax event that they could have avoided or significantly reduced if they had known what to do in the years before their RMDs started. Now, I want to address the specific context that makes this issue urgent for people watching this video in late 2024 and early 2025. If you were born in 1953, you turn 73 in 2026. That means your first RMD is due by April 1st, 2027, but it is based on your December 31st, 2025 account balance and counts as 2026 income. You have roughly 12 to 14 months from the time you are watching this video to take action before that RMD calculation is locked in. The strategies I am about to explain in the next section are most effective when you implement them before the year your RMD starts. Once the calendar flips to January 1st, 2026, your options become limited. Some strategies disappear entirely. Here's the second piece of timely context. As I mentioned earlier, the Tax Cuts and Jobs Act provisions expire on December 31st, 2025. There is ongoing debate in Congress about whether to extend them, but as of now, no extension has passed. That means 2025 may be the last year of historically low tax rates for the foreseeable future. If you are going to do Roth conversions, which I will explain in detail shortly, 2025 is potentially the best year to do them because you are converting at the lower 2017 tax rates instead of the higher post-2025 rates. Every dollar you convert in 2025 at 12% instead of 15% in 2026, or at 22% instead of 25%, is a permanent tax savings. The third piece of context is specific to IRMAA. IRMAA is based on your income from 2 years prior. That means your 2024 income determines your 2026 Medicare premiums. Your 2025 income determines your 2027 premiums. Your 2026 income, which includes your first RMD, determines your 2028 premiums. If you can keep your 2025 income below the IRMAA thresholds, you buy yourself one more year of standard Medicare premiums in 2027 before the surcharges kick in. That gives you time to plan and adjust. But if your income spikes in 2025 because you take a large Roth conversion or sell appreciated assets, you trigger IRMAA for 2027. The same year, you may also be dealing with your first RMD. The strategy is to be intentional about the timing and the amount. Small, planned increases in income over multiple years are almost always better than large, unplanned spikes in a single year. The fourth piece of context relates to qualified charitable distributions, or QCDs. Starting at age 70 and a half, you are allowed to transfer up to $105,000 per year in 2024, adjusted for inflation each year, directly from your IRA to a qualified charity. That transfer counts toward your RMD requirement, but it does not count as taxable income. If you are charitably inclined and you are facing a large RMD, QCDs are one of the most tax-efficient strategies available. But you have to be at least 70 and a half to use them. If you turn 73 in 2026, but you're not yet 70 and a half, QCDs are not available to you for your first RMD. But if you are already over 70 and a half, you can start using QCDs immediately, even before your RMDs officially begin, to reduce your IRA balance and lower your future RMDs. Now let me walk you through the specific strategies you can use to reduce or eliminate the RMD trap. These are not theoretical. These are the exact steps that tax planners use with clients who are facing this situation. Strategy 1, Roth conversions before age 73. A Roth conversion is when you take money out of your traditional IRA, pay income tax on it in the year you take it out, and move it into a Roth IRA. Once the money is in the Roth IRA, it grows tax-free, and you're never required to take RMDs from a Roth IRA during your lifetime. The goal is to convert enough money from your traditional IRA to your Roth IRA in the years before you turn 73 to significantly reduce your traditional IRA balance, which reduces your future RMDs. Here's the key. You want to convert up to the top of your current tax bracket without pushing yourself into the next bracket. If you are in the 12% bracket, you can convert enough to fill up that bracket and pay 12% tax on the conversion. That is far better than waiting until RMDs push you into the 22% or 25% bracket and paying those higher rates on money you are forced to withdraw. For 2024, the 12% bracket for a married couple filing jointly ends at $300 of taxable income. If your current taxable income is $40,000, you have approximately $54,000 of room in the 12% bracket. You could convert up to $54,000 from your traditional IRA to your Roth IRA and pay 12% tax on it. You do this every year from now until you turn 73. Each year, you reduce your traditional IRA balance by the amount you convert. By the time your RMDs start, your balance is lower, your RMDs are smaller, and the tax impact is reduced. Strategy 2, qualified charitable distributions starting at age 70 and a half. If you are charitably inclined and you're at least 70 and a half, you can direct your IRA custodian to transfer money directly from your IRA to a qualified 501(c)(3) charity. The transfer counts toward your RMD once you are required to take them, but it does not count as taxable income to you. The limit for 2024 is $105,000 per person per year. If you are married, you can each do a QCD from your own IRA, effectively doubling the limit. Even if you are not yet required to take RMDs, you can start doing QCDs at age 70 and a half to reduce your IRA balance before RMDs begin. Every dollar you transfer to charity via QCD is one less dollar in your IRA that will generate a future RMD. Strategy 3, delay Social Security to reduce taxable income in your early 70s. If you are not yet taking Social Security and you are in your late 60s or early 70s, consider delaying Social Security until age 70. Your benefit increases by approximately 8% per year for each year you delay between your full retirement age and age 70. Delaying Social Security reduces your taxable income in the years leading up to your RMDs, which gives you more room to do Roth conversions at lower tax rates without triggering IRMAA or higher taxation of Social Security benefits. This strategy requires that you have other sources of income to live on during the delay period. But if you have taxable savings or a Roth IRA you can draw from, the long-term tax benefit can be substantial. Strategy 4, spend down taxable accounts first. If you have money in 3 types of accounts, taxable brokerage accounts, tax-deferred accounts like IRAs, and tax-free accounts like Roth IRAs, the conventional wisdom is to spend down your taxable accounts first in early retirement. Delay touching your tax-deferred accounts as long as possible and leave your Roth accounts for last. But this can backfire if it means your traditional IRA grows to a massive balance by the time RMDs start. A better approach for many people is to strategically draw from all three types of accounts in a way that keeps your taxable income in a target range each year, minimizes taxes over your lifetime, and prevents large RMDs from creating tax spikes later. This is called tax bracket management, and it requires annual planning, but the savings can be enormous. Strategy 5. Consider a qualified longevity annuity contract, or QLAC. A QLAC is a special type of deferred annuity that you purchase with money from your IRA. The amount you put into a QLAC, up to $200,000 as of 2024, is excluded from your IRA balance for RMD calculation purposes. The annuity payments start at a later age, typically 80 or 85, and provide guaranteed income at that point. QLACs are not for everyone, and they come with trade-offs, including less flexibility and the risk that you may not live long enough to receive significant payments. But for someone with a very large IRA balance, who is worried about massive RMDs in their mid-70s, a QLAC can reduce the RMD calculation and defer taxes on a portion of the account. Strategy 6. File for an IRMAA reconsideration if you have a life-changing event. If your income spikes in a single year due to an RMD or any other event, but your ongoing income is actually lower, you can file for an IRMAA reconsideration with Social Security. Life-changing events that qualify include retirement, loss of a pension, divorce, or death of a spouse. If Social Security approves your reconsideration, they will recalculate your IRMAA based on more recent income instead of the 2-year look-back, which can significantly reduce your Medicare premiums. Let me give you the action steps clearly. Step 1, calculate your projected RMD. Take your current IRA and 401k balances, assume a reasonable growth rate, project what your balance will be on December 31st of the year before you turn 73, and divide by 26.5. That is your projected first RMD. Write that number down. Step 2, add your projected RMD to your other expected income for that year, including Social Security, pensions, investment income, and part-time work. That is your projected total income. Compare it to the IRMAA thresholds and the tax bracket thresholds. If it pushes you into a higher tier or bracket, you have a problem worth solving. Step 3, meet with a tax advisor or financial planner who specializes in retirement tax planning. Do not go to someone who just prepares your annual tax return. You need someone who does proactive multi-year tax projections. Ask them to run a Roth conversion analysis showing how much you can convert each year between now and age 73 without pushing yourself into a higher bracket or triggering IRMAA. Step 4. If you are charitably inclined and over age 70 and a half, contact your IRA custodian and ask them to set up a qualified charitable distribution. Most custodians have a simple form. You provide the charity's name and tax ID, specify the amount, and they send a check directly to the charity. You receive a receipt for your records. Do not have the check made out to you. It must go directly from the IRA to the charity to qualify. Step 5. If you have a 401k from a former employer, consider rolling it into an IRA. 401k plans are subject to RMDs, just like IRAs, but they do not allow QCDs. If you want the flexibility to use QCDs in the future, you need the money in an IRA. Step 6. Review your Social Security claiming strategy. If you have not yet claimed and you are in good health, run the numbers on delaying to age 70. Use the Social Security calculator at ssa.gov to see how your benefit increases with each year of delay. Compare that to the Roth conversion opportunities that delaying creates. Step 7. Set a reminder to review this every year. Tax laws change, your income changes, your account balances change. What makes sense this year may not make sense next year. Annual review is essential. Let me come back to David and Linda, the retired couple from Ohio who saw their taxes and Medicare premiums spike by over $35,000 in the 3 years following their first RMD. David contacted Jordan Retires about 8 months after they filed their 2026 tax return. He was angry, frustrated, and felt blindsided. He kept saying, "Why didn't anyone tell us this was coming? We had years to plan for this. We could have done something." He was right. They could have. I walked David and Linda through a retroactive analysis showing what their situation would have looked like if they had started Roth conversions in 2022. If they had converted $30,000 per year for 4 years from 2022 to 2025, they would have paid approximately $3,600 in tax per year on those conversions, totaling $14,400 over 4 years. But their traditional IRA balances in 2026 would have been $120,000 lower. Their combined RMD would have been approximately $37,000 instead of $41,500. That $4,500 difference would have kept them in a lower tax bracket and a lower IRMAA tier. Their total tax and premium cost over the 3-year period would have been approximately $52,000 instead of $87,000, a $35,000 savings, even after accounting for the $400 they paid on the conversions. David and Linda could not go back and undo 2026, but they could start implementing the strategies going forward. We set them up with a plan to do annual Roth conversions of the amount they could afford to convert without spiking their income further, to use QCDs for their charitable giving, starting immediately, and to carefully manage their tax bracket every year. David told me 6 months later that the most valuable thing he got from our conversation was not the money, although that mattered. It was the sense of control. He went from feeling like a victim of a system he did not understand to feeling like he had a plan and tools to execute it. That is what good tax planning does. It gives you control. If this video gave you something useful, please share it. Share it with anyone you know who's in their late 60s or early 70s with a significant IRA or 401k balance. Share it with your siblings, your friends, your parents. The window to act is closing for a lot of people, and most of them do not know it. Drop a comment below and tell me where you are in this process. Tell me if you have already started taking RMDs and what your experience has been. Tell me if you are doing Roth conversions and how you are planning around the 2025 tax law changes. And tell me what topics you want Jordan Retires to cover next. Every comment gets read, and every question helps me understand what this community needs most. If you found value here, hit that subscribe button. This is exactly the kind of information that saves people real money, but only if they get it in time to act.